So, what's going on with China's economy? Well, it's sending some pretty mixed signals lately. We're diving into a recent article from the Wall Street Journal, published on February 10th, 2024, that gives us a really important snapshot. Let's break down what these economic numbers really mean, not just for China, but, for all of us.
All right, so here's our game plan. We'll start with the big picture. Then we'll simplify a couple of key terms you need to know. After that, we're going to dig into why these prices are changing and who really wins or loses. And we'll wrap it all up with what to watch for next and the 3 biggest takeaways you should remember.
You can really think of this as a health checkup for China's massive economy. And just like a doctor checking your vitals, one of the first things we look at is the temperature. In this case, that temperature is measured by prices. So, are things heating up? Or are they starting to cool down?
And that leads us to the big question on everyone's mind. Is China's economy in trouble? Well, to get an answer, we have to look at those prices. And the latest numbers are definitely raising some eyebrows because they're pointing to a potential weakness in a really crucial area, demand from both shoppers and businesses inside the country.
Now, to really get what's happening, we need to get comfortable with 2 little acronyms from the article, CPI and PPI. I know they sound technical, but don't worry, the ideas behind them are super straightforward. They just tell 2 different sides of the exact same story.
Okay, first up is the CPI, or the Consumer Price Index. This is the one that affects you and me the most. It basically tracks the cost of a typical shopping cart, full of stuff, things like food, gas, and rent. So if the CPI is going up, your cost of living is rising. Simple as that.
And here's where it gets really interesting on the consumer side. Inflation slowed way down between December and January. You can see that big drop right here. This was a much steeper fall than economists were expecting, and it's a huge sign that people might be getting a little more cautious with their spending.
Now, the other side of the coin is the Producer Price Index, or PPI. This one tracks prices from the factory's point of view. It measures the price tag on goods right as they're leaving the factory gate before they even get to the store shelves.
And wow! The trend on the producer side is even more dramatic. Factory prices didn't just slow down, they actually fell by 1.4% in January compared to the year before. When prices keep falling like this, it's called deflation, and it can often be a sign of some deeper economic challenges.
And get this isn't just a 1-month thing. This trend of falling producer prices has been going on for 40 months in a row. That's over 3 years that factories have had to accept lower and lower prices for their products, and that really squeezes their ability to make a profit.
Okay, so why is this happening? What's going on behind these numbers? Well, there are a couple of key reasons, one of which is kind of temporary, but the other points to a much bigger issue for the economy. A big part of the story is something economists call base effects. Really, it's just a kind of statistical illusion. It just means that if you compare today's numbers to a time in the past that was unusually high or low, it can make today's situation look a little distorted.
And here is the perfect example of that. Last year, the huge Lunar New Year holiday, a time when people spend a ton of money, was in January, which pushed prices up. This year, the holiday moved to February. So naturally, when you compare this January to last January, it's going to look a whole lot weaker.
But beyond just the holiday timing, there is that deeper issue. As one economist, Zicheng Huang, puts it, there's a basic imbalance between supply and demand. To put it simply, China's factories are making more stuff than people are buying. And when you have a surplus of anything, prices tend to go down.
So what does this all actually mean for regular people and for businesses across China? Well, it turns out that falling prices can be a real double-edged sword. It creates some very different situations for consumers versus companies.
So for shoppers, hey, cheaper stuff sounds pretty good, right? But it's also a big warning sign. If prices are falling because nobody's buying, that means businesses are making less money. And that makes them less likely to give out raises or invest in new projects or hire more people. For businesses, the downside is way more direct. Falling prices just means lower profits. But, there is one potential silver lining in all this. Because prices aren't shooting up, the government has a lot more room to try and give the economy a boost. This is called stimulus. It could be things like spending more on projects or even cutting taxes to get people and companies to start spending again.
All right, let's pull this all together. What are the most important things you need to take away from this whole situation? And what should we all be keeping an eye on as the story continues to unfold?
Here are the 3 main takeaways. First, the event. Both consumer and factory prices are weak, and factory prices have been falling for a long time. Second, the meaning. This is a pretty clear signal that demand inside China's economy is just sluggish right now. And third, the future. Basically, everyone is now watching the government to see if it will step in with some stimulus to get things moving again.
And that leaves us with the billion-dollar question for what comes next. Will Beijing's policies be enough to warm up its cooling economy? The answer to that question won't just affect China. It's going to have major ripple effects on global markets and supply chains everywhere. We will definitely be watching this one closely.